Hi everybody. Since the time of recording, we've heard that Adnoc is undoing its decision to reduce July allocations to at least some lifters by 20%. With that said, the damage is already done, both reputationally and to lifters' hedges. We hope you enjoy the video and remember to like and subscribe.
Hi, my name's Will.
And I'm Ed.
We work on the officials, where we publish fair value curves at the close of Singapore and the close of Europe daily, and provide a rundown on what forces are driving price action throughout the day. So we've got an interesting two-parter in today's show. First, we'll be unpacking the pretty aggressive sell-off from the start of the week. I think that's a bit of
an understatement, really. The pretty aggressive, yeah.
And we'll also be unpacking some news we've had out of the Middle East about contractual issues with Adnoc loadings, specifically in Murban. So lots to unpack today. We'll start off with the sell-off. So we had a pretty big move down in flat price across all key crudes on Monday, didn't we? The market responded to Iran's retaliatory strikes against certain US air bases in the Middle East. We saw a big move up in flat price on the open, but that got sold into pretty heavily throughout the day.
Very, very heavily. It was down by more than $10 on the day. So we had a trading range where we went to, I think, 81.40 was the peak soon after the open on Monday morning, and then traded down through the day. And with the Iranian strikes that we had around 5 or 6 p.m. UK time, came off rapidly down to under 70.
Yeah, I mean, it was interesting to watch, really, because on the face of things, you have Iran directly striking US assets in the Middle East.
War.
That is
Middle Eastern war involving the US and Iran. That's a big deal.
Exactly. On the face of things, that looks pretty escalatory. The market was pretty responsive, at least, to the US's initial strikes on Fordo. We're recently seeing that it looks a little bit more orchestrated than perhaps
maybe a little bit choreographed, perhaps
a little bit like that. And so were the retaliatory strikes against the US air bases. But crucially, I think for oil markets, what people were worried about was, is Iran going to try and impose force majeure on the Strait of Hormuz? As we've discussed time and time again, that was not a realistic scenario, but there was still a bit of pricing.
It was still considered by the market as a risk, as a potential outcome. So you did see the flat price was inflated somewhat by that.
Yeah, but then when it became clear that a lot of this was theatre, all the US air bases that were struck by Iran seemed to have been evacuated in the run-up. A lot of the uranium from within.
Trump even banked Iran for an early warning of the attack. So
exactly,
it was very well prepared.
Exactly. So. They have hypersonic missile technology, which they've used to get through the Iron Dome, but they chose not to use it for this strike. So we just had the slow-moving cruise missiles, which were pretty easily intercepted. So that became very clear to markets, and that's why we had that big move down in flat price. This week it's continued to trend down, and now we're in a bit of a sideways range around the $67 a barrel mark. We seem to have found a bit of a floor there. I think we're stuck between the two. You've got the Chinese put at like 70, where they'll put the crude, but then you've also got the Trump call, I guess, where Trump loses patience with oil prices being too high.
He rotates his focus very rapidly. We've seen bomb Iran and then immediately go back to oil prices, drill baby drill. Oil prices are too high. I'm happy they've come down again. So it's a very rapid shift by Trump on the policy stance.
And to be fair, he achieved what he set out to achieve.
Yeah.
The ceasefire looked a little bit ropey at the beginning, but it seems to have
it's holding
solidified for a little bit. Obviously, you never know what's going to happen with these things. They don't have an excellent track record.
No, it could flare up, but I think the market has generally accepted that there is at least not going to be any supply disruption coming out of this Middle Eastern conflict. But there's another Middle Eastern conflict going on that's rattled a few cages because, as we reported last week, the allocation that Adnoc provided for certain nominations was 20% lower than it should have been.
Yeah.
So we'll show you an image of the contractual agreement for a loading, which should have been 500,000 barrels plus or minus, I think, 0.2%, and they've been allocated 400,000 barrels.
Yeah.
So just 20% of the crude that this lifter was expecting hasn't materialized because Adnoc has refused to provide it.
Yeah. So when you load crude at any port, there will be what's called an operational tolerance. This can be for a number of reasons. There may be, difficulties in fully loading a cargo, but those tolerances are pretty small. Like you said, 0.2%. So for example, cargoes deliverable into the Platts window have an operational tolerance of about 1,000 barrels, of 1,000 barrels exactly, actually. So now we've got an interesting scenario where Adnoc have basically ignored their pre-specified operational tolerance. They're under-allocating by a pretty substantial amount.
A huge amount. This is not substantial, this is massively important.
Exactly. But those lifters, those equity lifters in particular, that had resold those barrels, recycled them into the Platts window, are now in void of their contract in the Platts window. This is going to trigger a whole swathe of lawsuits. I mean, we're hearing that people are pretty unhappy about it, as I'm sure you can imagine.
Again, another understatement, the theme of the video. But so you expect to get 500,000 barrels. And obviously these physical players will not just take that and walk off. They'll have a hedge. So they'll have a hedge in place in a derivatives contract probably to offset the risk. So often they'll be using a futures or a swap contract to minimize their risk. And if you're expecting 500,000 barrels of physical oil, you're going to have to hedge for 500,000 barrels. If you're then only given 400,000, you have a 100,000 barrel overhang in your hedge, and you're left out in the cold at risk of price action.
And you probably sold those swaps when flat price was, trading in the low 60s.
Yeah, and then it goes up to 80.
But now you have to buy back that 100,000 barrels when prices are trading more like 78. 70, about 78
last week
for Dubai. So that's a huge loss. I mean, we're hearing losses in the region of $12 million on a cargo. It's not chump change.
No.
Traders are going to be chasing that loss legally. And at the end of the day, where does the ball stop? It stops with Adnoc.
Yeah, it's Adnoc that has unilaterally failed to provide the crude that it had nominated. And that's obviously having a knock-on effect down the chain to whoever's lifted from Adnoc and then sold on to somebody else. The final buyer is then frustrated, comes back to their seller has to go back to Adnoc, and it's a huge mess.
So, I mean, why do you think they under-allocated in the first place? Surely that's
I think it's where you see
foresight from them.
Where you see, okay, so we've allocated these at the price, say it was about $60 to $62, for example, and then you see prices have risen to 68, and you think, why are we selling all this oil at 62 when prices are at 68? So perhaps you think, let's not provide them with these 100,000 barrels now because we can sell it later for 68. But that kind of forgets that the OSP pricing and the pricing of these transactions is done retrospectively. And our Dubai explainer video on the window explains how the OSPs work in that they look back to the previous month to set the price for the month ahead.
Yeah. And I think there's another mechanism at play here. If you remember back to last month, Murban was the predominantly delivered grade, and that is that's their best grade. It's supposed to be trading at a consistent premium to other typically less valuable grades like Upper Zakum or Oman, which typically have a worse yield. But because of recent moves in fuel oil and diesel, we've seen the yields on Upper Zakums and Omans increase. And Adnoc, in response to that, they reduced their production forecasts, and now they're trying to.
So they were going to run more of the Murban domestically in the Alvarez refinery rather than export it. And this helped to boost the Murban pricing. We saw that at the beginning of the month, that Murban jumped compared to Dubai.
And as you said, you trade 2 months forward in the Murban futures, which are a physically delivered contract.
Yeah.
So it's not like you can go into the futures market to then cover your 100,000 barrels and just lift some more. You're stuck.
Yeah. And you also run the risk with on IFAD. So in the Abu Dhabi exchange where Murban contracts are traded, because they're physically delivered, and now there's this massive gaping hole of trust in the Murban and Adnoc system. If you go into IFAD and you say, I'll buy a Murban contract, you could then easily be left holding this Murban contract. No one else wants to get involved in IFAD because they're like, I don't know what Adnoc's actually going to give me. And then you're left holding this Murban contract and you have to take delivery of Murban at the end of the month that you just wanted to take and then sell again before expiry. Or equally, you sell a contract and then no one wants to buy it from you, and you end up with the obligation to deliver however many thousand barrels at the end of the month.
It's a whole mess. I mean, traders here at Onyx have been advised not to trade Murban futures. And I think that's going to be a consistent theme across other trade houses as well. If you're unable to exit a position that is physically deliverable and you get left holding, say 300,000 lots, that's a bad day.
Yeah.
So this is gonna have a whole host of reputational hazard for Adnoc, for IFAD, and for the Murban futures.
Yeah. There have been some sources that we've been talking to have said, perhaps exaggerating slightly, but they said IFAD is dead.
Yeah.
The hit to the trust is fatal. So it's a bit of a dramatic episode, but to wrap up, because we've covered a lot of ground today, we covered the market sell-off, people relieved perhaps that there's no disruption to the Strait of Hormuz, the Iran-US-Israel war seems to have subsided, the rather fragile ceasefire is holding, and then the failure to perform in terms of contractual obligations by Adnoc and its potential ramifications throughout the Middle Eastern pricing process and its consequences for IFAD, which could be terminal in some people's view. So with that, thank you for watching this episode, and we look forward to seeing you in next week's video.
Thanks for watching.